Hi guys, this is the part 3 of the chapter 1 of F3 Financial Accounting, which is Introduction to Financial Reporting. So before watching this, watch the part 1 and part 2. If you haven't watched it, I've linked it in the description box below. And if you need any other playlist, I've linked that also in the description box below. So we have to start from the categorizations of the assets, liabilities, and equity in the financial statements. So this is going to be hardly a 10-minute long video because this is something you already know. We just need to just go and clear certain concepts. So the first thing, there are some additional principles with regard to the classification of assets and liabilities that relate to the length of time they will be employed in the business. So there are two types of assets. Now you know what assets are. Assets are material items which are something which would help the business in growing, right? So now you know what asset is, you know what liability is, and you know what capital is. Now there are two types of assets. One is non-current assets and one is current assets. First, let's understand what the meaning of current is. So, what does current mean? Current means anything which belongs to 1 year or lesser than 1 year. What is non current assets? Non current assets is something which is more than 1 year. Non current, we're talking about the time period, right? Now, let's see again. What is current? Current means within 1 year. Current means within 1 year. And what is non-current? Non-current is more than 1 year. More than 1 year. So you can also assume that current means short term and non-current means long term. So now tell me, what does current asset mean and what does non-current asset mean? Non-current assets are any tangible or intangible assets acquired on a long-term basis to be used in providing a service to the business. Now, what is the meaning of tangible and intangible? Tangible means something that we can touch, intangible means something we cannot touch. So, what are tangible assets? Sofa, building, land, anything which we can physically touch. What are intangible assets? Having patents, brand value, goodwill, all of those things are not tangible, which means they are intangible because we cannot touch them or we cannot see them. So you know that non-current assets are long term. They are not held for resale in the normal course of trading, not expected to be realized within 12 months after the reporting period. So these are something which we keep over for a very long time, right? And if I have a business of, let's say, chocolates, I have a business of chocolates, and I have a machinery which manufactures the chocolates, and I have chocolates with me. Chocolates, are they assets of my business? Yes, they are. Are they current assets or non-current assets? If I manufacture a chocolate this year, then right now, then I will sell it right now only, right? So that is a current asset. Why? Because you're going to use it within the 12 months. But the machinery which we are using for the manufacturing of chocolates, is it a current asset or a non-current asset? Think about it. That machinery, we're not trading that is not our main source of business, right? Our business is of chocolates, our business is not of dealing with machineries, right? So that is a non-current asset because it is with us throughout more than 12 months, more than 1 year. So that is called as a non-current asset. Now we have examples of non-current assets: land, buildings, motor vehicles, plant and machinery. Now we come to what current assets are. Assets expected to be realized, sold, or consumed within the normal operating cycle. What is the normal operating cycle? Normal operating cycle is within 12 months. Realized within 12 months after the reporting period or held primarily for trading. What's the meaning of current assets? Examples: inventory, receivables, and cash. Now we come to liabilities. It is the same way again. Now that you know the meaning of current and you know the meaning of non-current. Now let's see how it applies in liabilities. Liabilities are claims on the business by outsiders. Current liabilities, let's first see current liabilities. Okay, we are first seeing current liabilities. Liabilities that are expected to be settled within the normal operating cycle or held primarily for trading or is due to be settled within 12 months after the reporting period, or there is not an unconditional right to defer settlement for at least 12 months after the reporting period. So it is the same as assets. So this is something which is within 12 months. Like for example, payables, bank overdraft, loans, short-term loans. We're not talking about long-term loans. We're talking about short-term loans. Why? Because short-term loans are something which you have to pay within the normal operating cycle. And what is the normal operating cycle? It is 12 months. Now let's come to what non-current liabilities are. Liabilities that have not been classified as current or payment can be deferred unconditionally for more than 12 months after the reporting period. So, obviously, non current liabilities are like long term loans, long term anything, something which can take more than 12 months. Now, I'm giving you a minute for you to answer these test your understanding 2 questions, and I will discuss the answers with you. Giving you 2 minutes. Okay, so the first thing we have is land and buildings. So, what do you know about land and buildings? Obviously, it is a non current asset because you're not selling it away within 1 year. That is something which is long term in nature, which means it is non current assets. Okay, non current means red and blue means current. So, what is land and building? It is non current. Receivables. What are receivables? And what do you think receivables should come into? So, receivables are obviously current in nature. Now, when it comes to cash, tell me what cash is. Is it current asset or is it non current asset? If you think about it and if you think about how we use cash, then you can understand that it is also a current asset. Loan repayable in 2 years of time, which is more than 12 months, which means it is non-current liability, right? Payables. Payables are always, receivables and payables are always current liabilities. Delivery van. Delivery van is a non-current asset, right? So you're done. Now let's come to what the components of financial statements are. So there are various components which are involved in the financial statements. So the first thing we have is a statement of financial position. What is a statement of financial position? A statement of financial position is nothing but a balance sheet. What is a statement of financial position? It is the statement of balance sheet. This statement summarizes the assets, liabilities, and equity balances of the business at the end of the reporting period. Classification or grouping of assets, liabilities, and equities in a consistent manner helps users of financial statements to understand that information and it more easily identify information which is of particular relevance to them. Consistent presentation of information also helps the users to make comparison and undertake analysis of the financial information. A specimen statement of financial position, including hypothetical monetary amounts, is illustrated below. So, this is a statement of financial position, which means this is the balance sheet of at 30 June 2000. That's the 7. So, we first have the non current assets, right? And then we have the current assets. So, property, plant, and equipment come under the non current assets. Inventory and trade receivable come under the current assets. And then we have what the total assets are. And what are the total assets? It is current assets plus Non-current assets. And then we have equity and liabilities. We have equity share capital, we have share premium, we have revaluation, retained earnings, and etc. So we'll go into the detail of them later on. Right now, just see the format. Now we have non-current liabilities and we have current liabilities. Note that there is a standard format to the statement of financial positions. Assets and liabilities have each been classified into either non-current or current items. Current assets are those which are expected to be converted into cash within 12 months of the reporting date. Non-current assets are those which are used in the business over a number of years to generate sales revenues and profits. Non-current liabilities are those which will be settled more than 12 months from the reporting date. What are current liabilities? Current liabilities are those which will be settled within 12 months of the reporting date. Now let's come to what the capital structure of a limited liability company will be. Explained in more detail somewhere else, right? So the capital structure, if you want to know about how the capital structure is of a limited liability company, we will see that in the following chapters. In the case of a sole trader, the items included under the equity section of the statement would be replaced by a simple capital account. So if there is a sole trader, then we wouldn't be having a separate equity column. Why? Because only one person is giving the entire capital, right? So that was about the statement of position, which is the balance sheet, which starts with the assets, goes on till the liability. Now we come to what the statement of profit and loss and other comprehensive income is. The statement summarizes the revenues earned and the expenses incurred by the business throughout the reporting period. So the statement of P&L or the statement of profit and loss, it has what the revenue the company has earned, what are the expenses which the company has incurred, and all of that is shown here. This is used to be referred to as profit and loss account. A specific statement of profit and loss and other comprehensive income, including hypothetical monetary amounts, is illustrated below. Okay, so this is how a statement of profit and loss looks like. First, we have sales revenue, and we have the cost of the sales which we subtract from the sales. By doing that, we get what the real profit is. Then we have a gross profit. Then we have what the distribution costs are, and we subtract that. We subtract all sort of expenses, and then we get what the operating profit is, and then we subtract the finance costs, then we get the profit before tax, then we subtract the income tax, then we get the profit of the year, and then whatever income else is left, we add that. Right now, don't get confused looking at these comprehensive terms, because we'll be looking at each one of them in the further chapter. Note that the statement classifies or groups expenses together based upon their function. Cost of sales, for example, may include the cost of raw materials to be converted into finished goods for sale. It may also include wages of employees directly involved. So yeah, you group the similar kind of expenses together in the P&L. Item accounted for in arriving at the profit for the year are regarded as having been realized during the accounting period. In addition, for limited companies, there may be an additional section to the statement to recognize items of other comprehensive income. So there might always be another ways from how you are like earning income. So that is what is shown in other comprehensive income. This will comprise of unrealized gains and losses during the accounting period and are separately disclosed in order to arrive at the total comprehensive income. The most common example of other comprehensive income which arises when an entity decides to account for an increase in the value of land and buildings. So whenever the building value increases, that is a profit for you, right? But that is not your basic operation. That is that is something which is a comprehensive income, which is an other income, right? Both the profit for the year and any items of other comprehensive income are reflected in the statement of financial position and also the statement of changes in equity at the end of the accounting period. Now let's see what the statement of changes in equity are. So whenever the changes are made in equity, all that is shown in a statement which is known as the statement of changes in equity. This statement summarizes the movement in equity balances, share capital, share premium, revaluation, surplus, retained earnings, all explained in greater detail. So, whenever the beginning of the reporting period is, it applies only to limited liability companies and would not be required for a sole trader or partnership. So, this is a statement and this is for the changes in the equity. So, how does it look like? We have the balance and then we have what the profit is. Then we subtract the dividend and then we have revaluation and then we have issue of share capital and then we get what the balance is. So, even this is something which we will be learning in the further chapters. Just remember that this is showing the changes in the equity. Now you have what the statement of cash flow is. And what is cash flow statement? We show the inflows of cash and the outflows of cash. The statement summarizes the cash paid and received throughout the reporting period. Normally, it would be relevant to limited liability companies only rather than to sole traders and partnerships. It will be explained in greater detail. Now we have the notes to financial statements. So whenever you make these financial statements, if you can recall, you make a note to accounts, right? You make another separate table or a column where you show the working of how you got a particular thing in the balance sheet. So that account which you make to show how you got a particular thing, that is known as a note to the financial statements. The notes to the financial statements comprise a statement of accounting policies and other disclosures required to enable to the shareholder and other users of the financial statements to make informed judgments about the business. So we always show the note to account so that whoever is using our financial information, they understand why we're writing what we're writing and where did that even come from. The notes to the financial statements are usually more detailed and extensive for limited liability company financial statements rather than for the accounts of a sole trader or partnership. Okay, now we come to the important accounting concepts. So these are some concepts which relate to accounting and these are very extremely important. So there are a number of other accounting principles that underpin the preparation of financial statement. So the first thing is materiality. So what do you think about materiality and what is materiality and why is it a very important concept in accounts? Let's talk about that. An item is regarded as material if its omission or misstatement is likely to change the perception or understanding of users of that information. So, if you can recall, we have done what materiality is in the business and technology exam. Do you remember? When we were studying the audit, we were aware of it. So, what is materiality? So, materiality is if a set of information, a particular set of information is called material. If if you had omitted that set of information, if it would change the perception of the readers, then it is a material error. Why material information? Why? Because it is something which changes the meaning and perception of the entire thing. It requires them to consider the reliability of the financial statements for decision making purposes by users, principally the shareholders. For example, consider if the bank balance of a large entity, such as a company listed on the stock exchange, misstated by $1 in the statement of financial position. This may not be regarded as a material misstatement, which would significantly distort the relevance and reliability of the financial statement. See, if you would have misstated something by $1, by 1 rupee, by one anything, then maybe it's not a material error because it wouldn't really matter much. If it was a error of $10,000, then it is a material error. Why is it then a material error? Because that is something which will influence my thinking, which will influence my decision making, right? So that is when we say that it is material. However, if the bank balance was misstated by rupees $100,000, this is more likely to be regarded as a material misstatement and significantly distorts the information included in the financial statements. So I hope you understood what materiality is. Now we have what we call the substance over form. So, what is substance over form? We have seen that in the further part 2 of this chapter. As noted earlier, if information is to be presented faithfully, the economic reality must be accounted for and not just the strict legal form. An example of substance over form that you will encounter later in the text is an accounting treatment of redeemable preference shares. Although on legal form they are shares, there is an obligation to repay the preference shareholders, so they have to be accounted for as debt. Okay, so we'll come to what the shareholders are, what equity shareholders are, what preference shareholders are. That we'll come later on. But what you need to understand here is that substance over form, which means if you need to present something faithfully, you need to mention anything that is right, and if something is a debt, you need to show. If something is not a debt, if something is a profit, you need to show that. You need it to be in substance form. Now we have what the going concern assumption is. Now, what is going concern assumption? This is a very basic accountancy principle or a very important assumption, which is the going concern assumption. Financial statements are prepared on the assumption that the entity is a going concern and will continue to operate for a foreseeable future. Okay, so going concern principle. So, whenever you use the accounting principles, you just assume that a business will go on forever. You assume that the business will go on for a foreseeable um, period. You just assume that business will not wind up and it will continue to go on forever. That is what is known as a going concern principle. The business entity concept. Okay, now what is a business entity concept? You need to always keep in mind that the business is separate from the owner, which means the business entity is separate and the owner is separate. You can never say that the business's bank account is the owner's bank account. Business is always separate from the owner, and that is what is known as the business entity concept. Now we come to what the accrual basis of accounting is. So this is really important and we need to keep in mind what accrual really means. This means that transactions are recorded when revenues are earned and when expenses are incurred. This pays no regard to the timing of the cash payment or receipt. For example, if a business enters into a contractual agreement to sell goods to another entity, the sale is recorded when the contractual duty has been satisfied. That is likely to be when the goods have been supplied and accepted by the customer. The payment may not be received for another month, but in accounting terms, the sale has taken place and should be recognized in the financial statements. So, I hope you understood what the accrual basis of accounting is. It means that it has nothing to do with whether we are receiving the money or whether we are not receiving the money. If a particular event has taken place, it needs to be mentioned in the financial statements there and then. If you have taken a loan, the liability has to be mentioned right now itself and not after you have paid it. So that is what is known as an accrual basis of accounting. Now we have the prudence concept. So let's see what the prudence concept is. So preparers of financial statements should exercise prudence when preparing financial statements. Assets and income should not be overstated or understated, right? Assets should not be overstated while the liability should not be understated. However, care must be exercised to ensure that there is no deliberate misstatement of assets and liabilities. So, what do you understand? Prudence principle means we need to see that things are not overstated and things are not understated, and losses are always there mentioned. Now, let's see what the consistency is. Consistency is that you need to use the same principles, the same format, the same procedure every year. You need to be consistent with whatever methodology you are using. So, what are the principles we saw? We saw what materiality is, we saw what substance over form is, we saw what going concern is, business entity, accruals, um, prudence, and consistency. Which of the following statements is correct? Only tangible assets are recognized in the financial statement. That's not true. The assets can be tangible, the assets can be intangible. Faithful representation means that the commercial effect of a transaction must always be shown in the financial statements, even if it differs from the legal form. Yes. Why is it true? Because this is a substance over form. Businesses only report transactions, events, and balances that are material to users of the financial statement. Is that true? Think about it. That's not true. Why? Because businesses must report things whether they are material or whether they are not material. They have to report anything and everything which is required. So the answer is C, which is 2 only. So this is the chapter summary. You can check it out. Right? And in this chapter we don't even have the back questions. So I hope you understood this chapter. This is like the basic first chapter of the financial accounting. In the following chapters we'll be doing stuff in more detail. The first few chapters are theoretical in nature, but however after you finish that, things won't be in theoretical nature anymore. Thank you.